All right, let's get right into it. Have you ever wondered how a professional analyst really looks at the stock market? It's not about crystal balls or some secret formula. It's actually a structured playbook, a real method to the madness of finding value. And in this explainer, we're going to break down that exact playbook, step by step. So this really gets to the heart of it, right? The big question, is investing just a fancy form of educated guessing? I mean, it can definitely feel that way sometimes, with prices flying up and down. But what we're going to see is that analysts have a process that's specifically designed to move way beyond guesswork and get closer to a calculated, logical decision. And that whole process really starts with this one core idea. From Warren Buffett himself, price is what you pay, value is what you get. This quote, it just perfectly captures the central puzzle that analysts are trying to solve every single day. The price flashing on your screen, well, that's one thing, but figuring out what a company is truly worth, that is the real game. So how in the world do they even begin to solve that puzzle? Well, the first step, and this might surprise you, isn't to just dive in and look at a hot stock tip. Nope, it's to zoom all the way out and start with the big picture. They use something called a top-down funnel, or you might hear it called the economy, industry, company framework. Think about it. They start super broad with the entire economy, then they narrow their focus to promising industries within that economy, and only then, at the very end, do they start digging into specific companies. It's all about systematically narrowing the field. So when they're looking at the economy, what are they really looking for? Well, they're checking its vital signs. Things like GDP growth, is the whole economic pie getting bigger or smaller? They're watching inflation, keeping an eye on interest rates, and tracking government policy. You got to remember, these big factors create the overall climate that every single business has to operate in. And here's the thing, that economic climate affects different industries in completely different ways. You've got your defensive industries, like food and healthcare. Think of them like all-terrain vehicles. Demand for their stuff stays pretty steady no matter what's going on. But then you have deep cyclical industries, like steel or heavy machinery. These are more like convertibles. They're amazing when the sun is shining in an economic boom, but they get absolutely soaked in a recession. Knowing this helps an analyst figure out where to even start looking. Okay, so we've worked our way down the funnel. We've gone from the huge macro economy to a much more focused, promising industry. Now we get to the real detective work, understanding the specific business. But hold on a second. You might be thinking, aren't all companies in the same industry kind of the same? I mean, if you're looking at two big software companies or two major airlines, what's really the difference? This is where a fantastic analogy comes in. Think about it like this. Rahul Dravid and Virendra Sehwag were both great batsmen, but were two very different players. One was known as the Wall, a master of defense. The other was an explosive, aggressive opener. Same sport, same goal, but their approach, their style, their stats, worlds apart. And it is exactly the same for companies. Two businesses in the very same industry can have a totally different style. That's their business model. They can have wildly different statistics. That's their financial health. And they can have a completely different strategy, which is all about the management's vision. A great analyst lives in these details. Now, to really get a handle on that competitive landscape, analysts have this awesome tool called Porter's 5 Forces. It's basically a framework that helps them figure out where the power lies in an industry. They look at the threat of new competition, the power of buyers and suppliers, the risk of substitute products, and how intense the rivalry is. It's all about gauging just how profitable an industry can be for the companies in it. So at the end of the day, it's not just about crunching numbers in a spreadsheet. A good analyst has to become an expert on the business itself. What's its unique advantage? What's its business model? And, maybe most importantly, are the people running the show any good? All right, so after all that intense research on the economy, the industry, and the company, we finally get to the main event. This is where it all comes together. It's time to figure out that crucial difference between price and value. The stock market, it's pretty generous in one respect. It gives you a price. Every single second of every trading day, there it is, jumping around for the whole world to see. But an analyst's real job is to tune out all that noise and calculate the value. This isn't some random number. It's the company's intrinsic value, an estimate of its worth based on cold, hard fundamentals, its assets, its earnings, its future growth. And this is where the magic happens. An analyst might find that a stock's market price is, let's say, 80 rupees a share. But after all their digging, their calculation of its real value is closer to 120 rupees. See that gap? That's the opportunity. That's the potential for a great investment. In fact, that gap has a name. It's called the margin of safety. And this is one of the most powerful concepts in all of investing. It's your buffer. It's your cushion in case you're a little bit wrong in your analysis or if something unexpected happens to the company. The wider that gap is between the true value and the price you pay, the bigger your margin of safety. So how do analysts compare companies quickly? Well, they use a whole toolkit of valuation ratios. You've probably heard of the PE ratio, right? Price to earnings. It's great for profitable companies. Then there's the price to book ratio, which can be better for companies with lots of physical assets, like banks. These aren't magic answers, but they are incredibly useful for getting a quick snapshot of whether a company looks cheap or expensive compared to its peers. Okay, time for the final and maybe most important piece of the puzzle. We've gone through this whole rigorous process, but what is the analyst's real edge? What's the secret sauce? Well, it really boils down to this incredible insight from the father of value investing, Benjamin Graham. He said, markets are more psychological and less logical. This is so key. The biggest risks you face often don't come from a faulty spreadsheet. They come from your own mind. The analyst's truest enemy is often their own brain and its built-in biases. Things like herd mentality, just following the crowd because it feels safe, or loss aversion, that feeling where the pain of a loss is way more intense than the joy of an equal gain. There's anchoring, where you get stuck on the first piece of info you see, and even a winner's curse, where you get so caught up in winning a bid that you end up overpaying. Beating these mental traps is half the battle. So you see, the true edge isn't about having a crystal ball that predicts the future. It's about discipline. It's about having the discipline to stick to a proven process day in and day out, and having the emotional control to not get swept away by the market's crazy mood swings. And that brings us right back to where we started. What's the real difference between smart, systematic investing and just plain guessing? It's that combination, doing the deep research, performing the careful analysis, and crucially, keeping a cool head when everyone else is losing theirs. The ultimate goal, as all the greats will tell you, is to buy a wonderful business at a fair price. It sounds so simple, but it is so incredibly difficult to do in practice. So, the question I'll leave you with is this. The next time you look at an investment, what crucial element in the economy, the industry, the business, or maybe even in your own thinking, could you be overlooking?